Hello everybody, my name is Graham Allen. I'm the Regional Wealth Leader for the eastern part of Canada, and I hope everybody's enjoying this start to the summer and ready for the next hour. Every session we put on IDC is designed to engage. It's designed to provide thought and designed to provide solutions to providing revenue streams for your businesses. That's what this is all about. It's not just not filling the calendar. We're trying to actually bring proper information that you can use in the everyday interactions with your clients. Today we're going to have a juvenile focus, and I feel that's the perfect entry point for younger clients. For maybe it's not always a target of the older clients to start with. We can start with a younger client and work our way up, progress to get into grandparents and the older generation. Along the way, help with accumulation and providing protection for the goals and desires for the future. Personally, I feel this is a real bridge to legacy planning, and engaging grandparents, engaging that demographic that is quite often difficult to get to. Some of these people have the relationships are deeply tied to banks or whatever, and I know the challenge for many advisors is getting to those people and getting credibility and starting with the discussion on education and providing planning and saving for the future. Can only help. So we're looking forward to this for this next session. Hopefully, we get to see the merits and the value points of adding this product line. And really, and to IA's credits, they're one of the few companies that have certain products we're going to be discussing today available in the marketplace. So, as a one-stop for the newer advisors out there, as a one-stop to build your business and build some really decent relationships with the wholesaling teams nationally, IA is a fantastic company to work with. And as you've all noticed, I've got my IA glasses on today. Thank you, Fraser, for providing those. Fraser, smile, enjoy. This is going to be a good hour. Really looking forward to it. And with that, I'm going to hand over to Fraser Grimes, joining us from IA. I know he's going to bring some enthusiasm and words of wisdom for the next hour.
Thank you, Graham, for the lovely words of introduction and for hosting us today here for IDC Children's Day presentation on RESPs, generational wealth transfers, and some child whole life and critical illness concepts. I'll be your host today, and my name is Fraser Grimes. I'm the Inside Sales Associate for Ontario, supporting the Sales Director, Angelina Bassara. I'm just going to start by putting up both my biography along with Angelina's here. We both have a cumulative amount of 13 years experience in the industry between the two of us. Angelina is the sales director for IDC in Ontario and your first point of contact for any questions related to any of the products that we discussed today, along with myself. Of course, we are a national sales team, and I am very happy to also have all the other wholesalers from across the country on the call with us here today. If you're unfamiliar with your IA wholesaler or their inside sales associate, please take note of the contacts on the screen coast to coast. If you do have any administrative questions, I want to point out that we also have a fantastic client services line just below with a 1-800 number and an email address. They're always there to help you, support you, and answer any of your questions to do with anything administrative, such as finding documents, illustration tools, or various things on the IA website you may be unfamiliar with. Our first part of the presentation today is going to focus around the RESP. We're going to discuss how the RESP works, various RESP plan types, the contributions that are made to RESPs, and the grants associated with them that can be both advantageous for your clients and for their beneficiaries. To start, we're going to identify the three different types of RESP plans available in Canada. The first one is the individual RESP plan. This is a plan for a single beneficiary and can be subscribed by essentially anyone who has a relationship with the child. It does not have to be blood or adoptive in this case. However, this plan is only for one beneficiary. As a result, there is also a family plan available, which has the possibility of designating more than one beneficiary within the RESP plan. The subscriber in this plan must have a blood or adoptive relationship with the beneficiary it is associated with. This means that the plan holder could be either parents, grandparents, brothers, sisters, or aunts and uncles that open the family plan for the beneficiary. The final plan that we will discuss and only touch upon briefly today is a group or foundations plan, which is founded through a group of people who are non-family members by pooling a group investment together, such as some scholarship plan providers like Knowledge First might do. Who offers RESPs in Canada, and how are they available to you and your clients? Well, to break it down into a lovely pie chart that we have on screen here, these are the assets that are available in RESPs as provided by the type of promoter. Scholarship plan dealers like Knowledge First, the one we just discussed moments ago, represent about 21% of the marketplace. Traditional banking institutions represent 30% of the overall marketplace for RESPs, where investment services represent a bulk of it at 45%. Insurance and other carriers only represent about 5% of the marketplace, so we think this is a massive opportunity for both you and your clients to get invested in segregated funds for RESP purposes. Let's break down the RESP a little bit further and what components essentially make up an RESP plan. First and foremost, there is a subscriber to the plan. These are the people who are actually contributing to the plan on behalf of the beneficiary and cumulatively saving for their educational future. Of course, this is tied to the government incentives that are available within the RESP plan. We're going to talk a little bit more about the government incentives later in this presentation, but I do want to mention that two are available federally. That would be the Canadian Educational Savings Grant and the Canadian Learning Bond. We'll refer to those as the CESG and the CLB throughout this presentation. Finally, and the most important component of the RESP plan is the beneficiary. This is the person who the RESP plan is for at the end of the day. We want to make sure that your clients are maximizing their RESP room and their contributions to ensure that their beneficiary has the most amount available for them when it comes time to pursue their post-secondary education or graduate education. RESPs work through a various set of length, contributions, and accumulations, ultimately for the benefit of the beneficiary. This starts when subscribers begin an RESP plan for their child to take advantage of government grants. Essentially, what they would do over the course of the RESP's lifetime is they will contribute to it, thus growing their contributions, but also accumulating interest and savings over time. This grows tax-free. In the final stage of the RESP, the grants and the interest are, of course, the first things to be withdrawn as part of an educational assistance payment, which we will talk about a little bit later in the presentation. I want to mention that contributions can be returned to the subscriber, but are primarily used for educational purposes in the RESP. What we want is we want your clients to accumulate RESP savings over the course of their beneficiary's lifetime, along with the grants associated with them, so that their child or beneficiary can go to university with the most amount of money available to pay for their education. There's a lot of opportunities for RESPs in Canada, and in fact, in 2021, a Canada Life study showed that a majority of Canadians, 92% in fact, are aware of the RESP's existence. Having said that, only 49% of Canadians are actually using a formal RESP savings tool to take advantage of these lucrative government grants. That means that overall in the marketplace, roughly 50% does not have an RESP. So 1 in every 2 clients potentially that walks into your office with beneficiaries or young children are not yet taking advantage of this incredible program. There are also, in the same study that Canada Life run, it also indicated that there are 56.7% of children in Canada that are receiving federal education incentives in the RESP. However, that does demonstrate that there is a large percentage of the population that is not receiving any incentives prior to the age of 17. In the same Canada Life study, research also showed that children who are of the age of 17-18 are acutely aware of their parents' financial standing. If their parents are under financial constraints or don't have post-secondary education set aside, children might not be likely to attend post-secondary school for fear of putting financial constraints on the family. This is why RESPs are incredibly important, not just for the beneficiary, but also for the parents themselves to offset some of the major costs of education in Canada. In 2022, we also anticipated through the EDSC that around 147,000 18-year-olds have not yet received the Canadian Learning Bond available for them between the ages of 18 and 21. What this also means is that those individuals are not taking advantage of the lucrative grants available to them. This can be a great way to get your clients' kids involved in investing their own money and actually taking on responsibility for managing their own funds. It can be an incredible opportunity not only for them to save for their education, but to be introduced to you, their advisor, and potentially help them with their future planning, such as TFSAs and RRSPs. A question that we commonly get with regards to RESP programs is how does the CESG and the CLB work for immigrants from another country? Unlike children who are born in Canada, if a family has immigrated to Canada, the CESG grant starts to accumulate on the year that they actually arrived. In the example below, a family who arrives in Canada in 2019 with a 5-year-old beneficiary would start accumulating the grant in that year. Unfortunately, we cannot go back to the date of the child's birth to recuperate previous grants, but we can go back as far as their initial landing in Canada to accumulate what they are entitled to there. One of the starkest statistics about RESPs in general is how the industry has grown over the course of the past 10 years. In a 2020 study, we have shown that the RESP industry has actually exceeded $70 billion overall in Canada, with people putting money aside to finance their children's post-secondary studies. This is at a rate of increase around 4 to 5 billion per year, which just demonstrates the incredible immensity of the RESP itself. As RESP assets continue to increase, I encourage you and your clients to have a discussion about saving for their child's future education and about actually being able to put money aside. If we take a look at our next slide, which is actually based on the opportunities in Canada for children to have RESPs, there are 7.2 million children nationally that are eligible to receive these benefits. These benefits range province to province, but overall the numbers speak for themselves. There are a lot of kids in the country that could use post-secondary savings to pay for their education, especially considering that only 1 in 2 Canadians actually holds an RESP plan. Now, this study is from 2020, and Canada's population has since exceeded the $40 million mark, meaning there are even more eligible children, both born and immigrated to Canada, that can be eligible for the RESP program. Investing in an RESP can be a bit of a personal project. Investments can range from as low as $100 to as high as the government maximum of $2,500 annually. What I mean by the government maximum, of course, we'll talk about in the further slides to come, but a contribution of $2,500 annually will maximize the government grants of $500 per year for the CESG. As we can see from 2010 through to 2020, contributions have increased by about $200. But even as of 2020, that mark is still about $850 short of the maximum contributions for RESPs to really take advantage of the government grants available. I want to point this out in the presentation today as a result to show to you that your clients can always be contributing a little bit more in order to get a little bit more from the government. In the next section of our presentation, we'll focus strictly on contributions. We're going to start by talking about the annual amount for grants, moving on to some of the contributions and how they can be used in an RESP plan. As I mentioned previously, $2,500 is the amount of annual contribution for an RESP in order to achieve the maximum amount of grants. This is also supplemented with additional grants that we'll talk about a little bit later in the presentation that are based on net income of the family. $36,000 is the natural limit for maximizing these grants if contributed since the child was a newborn. This is only for basic grants and does not factor in additional grants that can also be added on top of this. The last point is $50,000 does indicate the total contribution ceiling for RESPs. Your clients might be a little bit overzealous and potentially want to increase past the $50,000 contribution ceiling. I do want to mention in this presentation that because there is a ceiling of $50,000 on the RESP plans, anytime clients do exceed these contributions, they are taxed at a rate of 1% per dollar over the $50,000 limit. It's a lot like ice cream. If you eat a little bit, it's good. And if you can contribute a little bit to an RESP plan, it's great. But anytime we eat too much ice cream or we go over the RESP contributions, we're going to get a stomach ache, especially when it comes to tax time and RESP contributions. This is a little demonstration of what we can do for a beneficiary who has set up an RESP at the age of 4. Because RESPs do have deferred contribution room that is accumulated year over year, when a 4-year-old beneficiary is set up with an RESP plan, they'll have a deferred room of $10,000. This illustration does assume that the client was born in Canada and has about 4 years that they need to make up for in the RESP contribution. From the ages of 4 through to the age of 7, $5,000 are then contributed by the parents, thus decreasing the overall contribution room available. If the family does come under some sort of financial hardship or financial constraints, as indicated by the age of 9 on the slide in front of you to the right-hand side, there is additional room that would be added. In this example, the parents only contribute $1,000 when the child is the age of 9, leaving them with $1,500 that they could potentially make up in a future year. I want to also point out that if this was an example for an immigrant and the beneficiary had arrived in Canada at the age of 4, they would not be able to go back and recuperate the previous grants that they had missed out on. Using contributions in an RESP can be done in several different ways. The first and foremost way of using RESP contributions, of course, and the one that we want to encourage your clients to use, is to pay for the beneficiary's post-secondary studies. Contributions can also be transferred to an RRSP and or used for tax savings incentives in contribution to a TFSA. We can also contribute the proceeds of an RESP to an RRSP and use the tax savings to potentially pay for personal post-secondary studies. This would be through the lifelong learning plan offered through the Government of Canada. And finally, RESP contributions can also be used to repay educational debts. In the next section of our presentation, we're going to be discussing grants, specifically the CESG and the CLB. But for our friends out west in BC, we will touch upon the BC Provincial Savings Grant, and we will also talk about the QESI, the Quebec Educational Savings Incentive. There are some general rules that need to be followed when it comes to RESP grants and who is actually eligible for them. A beneficiary must be age 17 or younger as per the calendar year that they've reached the age of 17 before December 31st. Beneficiaries that are over the age of 17, ages 18 to 21, will actually be eligible as adult beneficiaries for the CLB, but unfortunately will not be eligible for the CESG. A question we commonly get in regards to RESP are, does my beneficiary need a SIN number? I want to stress in this presentation that a SIN number for a beneficiary is absolutely mandatory and necessary in order to set one up. The client also needs to be a Canadian resident. We do allow for temporary workers to open RESPs as long as they have a temporary SIN number associated with the beneficiary we are opening it for, and as long as the subscriber also has a SIN number. There's also some other rules for eligibility based on the age of the client themselves and their beneficiary. If the amount, for example, is less than $2,000 that has been contributed in the calendar year where the child reaches 15 years of age, they might not be eligible for the CESG. I stress this because a lot of clients do want to open RESPs later in life for their beneficiaries when they might be in a little bit of a better financial standing. If so, $2,000 must be contributed at the very minimum before the end of the calendar year in which the child turns 15. Alternatively, if an RESP was perhaps opened prior to then, an amount of $100 has to be contributed at the very minimum for at least 4 years preceding the calendar year where their child turns 15. An example of this would be an 11-year-old beneficiary has a newly opened RESP, but unfortunately due to financial constraints, the parents are unable to contribute the $2,500 annual contribution maximum. As a result of this, they contribute $100 a year for 4 years. This still renders them eligible for the CESG if they want to go back and recuperate previous years and contribute more in the years to come leading up to the child's university education. As I've mentioned in this presentation, there are the 2 major grants available in Canada, the CESG, which has additional room on it that we will talk about in the slide to come. The Canada Learning Bond is also available for families that are of a lower income. In the provinces of BC and Quebec, there are provincial grants for RESPs, such as the BC TESG, the British Columbia Training Education Savings Grant, and the Quebec Education Savings Incentive, or the QESI. Let's talk about the additional CESG grants and what qualifies. As I've mentioned in this presentation, basic CESG can be maximized at $500 per year, or 20% of the overall contribution. So with a $2,500 contribution, $500 in CESG grants can be applied to the child's RESP. If the income of the family is below $50,000, an additional 20% grant will be added for up to $100 per year, allowing those clients to reach the maximum grant room, $7,200, a little bit faster. If their income of the family is above $50,000 and below $100,000, an additional 10% grant will also be added to the RESP, which can be an amount of $50 per year, again, allowing your clients to reach that maximum grant room a little bit quicker and accumulate savings within their child's RESP. As a general rule, and something that is available to all Canadians, both the CESG and the CLB can be awarded to Canadian children, regardless of their net family income. The grant for the CLB, I want to mention, is awarded whether or not there's even a contribution in an RESP for the child's name. You might have some clients that have approached you potentially with a piece of paper from the Government of Canada indicating that their beneficiary is eligible for the CLB. This means likely that they did not open an RESP earlier in their child's life and now are being offered the CLB incentive as a result of it. This can help them pay for university, but they don't need to stop there. Because the adult is now the age of majority, they can actually open their own RESP, becoming their own subscriber, and again, helping them to manage their own finances, potentially taking some stress off of their parents. I want to also mention that the CESG, on the other side of the fence, is available to all Canadian children regardless of family income. Minimum amounts do need to be contributed, but as long as the RESP is opened early in the beneficiary's life, we can always go back and recuperate previous grants as illustrated in some of the previous slides. As opposed to the CLB, the net family income will vary according to the number of children per family, meaning that the CLB itself could vary according to the number of children within that family as well. The BC Provincial Grant, or the BC Training and Education Savings Grant, has to be requested between the child's 6th birthday and the 9th birthday. I want to stress in this part of the presentation that anyone in this age bracket qualifies for the additional grant, and it's an amazing incentive to open an RESP early for beneficiaries who reside in the province of British Columbia. The province of BC offers this one-time grant as an addition on top of the federal grants for $1,200. It's an amazing incentive to get clients to open an RESP when their beneficiaries are young, also allowing them to save a little bit more and accumulate more grants as a result of it. If you do have questions about the BC TESG, I highly recommend contacting your sales associate, which would be Barbara Vaughn, or your sales director, Hilda Ng, in British Columbia. Similar to the CESG, the QESI is structured quite the same way. It is based on net family income and is a 10% grant based on the contributions made per year. This has an annual contribution ceiling and grant allocation of $250 per child, and a lifetime maximum of grants accumulated is $3,600. There is an additional grant that can help families reach this goal a little bit faster, and this is based, much like the CESG, on the net family income of the family. If the family's income is lower than $46,000, 10% will be allocated for a maximum of $50 per year. If the net family income exceeds $46,000 and is less than $92,000, 5% can be allocated to the beneficiaries for a maximum of $25 per year. Similar to the BC Education Savings Grant, this is available to all children in the province of Quebec, regardless of the net family income. Again, if you have questions about this and reside in the province of Quebec, please reach out to your wholesaler, Mark Holden, or his sales associate, Elaine Lavoie. In this portion of the presentation, we're just going to briefly touch upon the accumulated investment income that occurs in an RESP and what we can do for it to ensure that your clients are taking advantage of it tax-wise. Accumulated income and grants at the end of the day do belong to the beneficiary. This is by default. It is non-taxable as long as there are no redemptions within the RESP prior to making an AIP, an accumulated income payment, or an EAP, an educational assistance payment. When an EAP is made, I want to point out that it will be taxable for the beneficiary in the form of an income. So in the next slides, we're going to actually talk about using the RESP specifically for these two different types of payments, the EAP and the AIP, which can be the most complex. We'll also briefly touch upon the PSE, the post-secondary education withdrawals, and what they can do for you and your clients and the differences between their limitations. The educational assistant payment varies based on whether the student is full-time in their post-secondary studies or part-time in their post-secondary studies. 10 hours per week for a 13-week period indicates that this is a full-time student. There is a limit for EAP withdrawals of $5,000 for the first request. An EAP withdrawal can only be made from the grants and interests accumulated within an RESP. I want to point this out because the limits only apply to the grants and income, whereas contributions themselves have no limits or tax implications when being withdrawn. When the EAPs are made, as I mentioned on the previous slide, this is done as a form of income to the beneficiary. For part-time post-secondary students, there is 12 hours per month that is mandatory over the course of a 13-week period. As a result of this, the limit is quite a bit lower than for full-time students and is only $2,500 in the first request. Similarly, however, contributions don't have a limit or tax implication as well with this. And finally, I want to touch upon proof of registration, which we often get questions here. Proof of registration can be a myriad of different sources, including a letter from the register, an invoice or receipt, a T2202, proof of online enrollment, or a student's timetable to show that they are enrolled. All of these would be accepted, and if you do have any questions, please reach out to your local wholesaler or their inside sales associate. Eligible studies for the EAP include professional training, trade schools, CEGP programs, and of course, universities in Canada. The EAP can also be withdrawn for students outside of Canada. However, there are 3 factors that need to be verified before making an EAP payment of this kind. The beneficiary must remain a Canadian resident, the program must last a minimum of at least 3 weeks, and it must be at the post-secondary or graduate level. If the beneficiary does not pursue a post-secondary education, there are 3 options that the subscriber or the parent now has. They can transfer to an RRSP for them or for their spouse where they are the contributor. They can also withdraw through what we've just discussed as an AIP or an accumulated income payment. And finally, they can also gift it as a donation to an educational institution of their choosing. What I want to point out on this slide is that all contributions and interest must be withdrawn by the 35th year of the RESP plan's existence. And I also want to note in this instance, if any of these withdrawals AIP methods are chosen, the grants must be reimbursed to the government. They are not something that can be transferred to an RRSP, withdrawn to a bank account, or gifted to an educational institution. So let's talk about the AIP a little bit before we get into some of the other topics on RESPs. The eligibility for an AIP is as such. The RESP must have been in existence for at least 10 years before making an AIP payment. The beneficiary must be at least age 21 or older, and the subscriber must still reside in the country of Canada. There are some mechanics also to keep in mind when doing an AIP payment. There is taxation that would be in the form of income, and if withdrawn by the subscriber, that would be towards them. There's no tax on rollovers to the RRSP if the T1171 is used. However, $50K or $50,000 is the maximum amount that can be rolled over. There's also a 20% additional tax on withdrawals from using the AIP program. And of course, the AIP must be terminated February 28th of the year following the first payment. This is, however, a slight incentive as it will allow your clients to roll over these taxes over 2 fiscal years. The most advantageous method of doing an AIP for clients who have beneficiaries not attending post-secondary school would be transferring the income to an RRSP or a special RSP, as it avoids additional income tax. I do want to note that the initial subscriber must be the person transferring this income as both the contributor to their own RSP or the contributor to their spousal RSP. We're briefly going to talk about RESP loans in the next portion of our presentation, including a little demonstration of what RESP loans can do to help your clients accumulate interest and grants within their beneficiary's RESP. There's a lot of advantages to using the RESP loan. However, first and foremost, it's the easiest and most effective way to increase the AUM of the RESP in order to get more interest without actually modifying a client's budget. They might already be contributing monthly to an RESP, and in order to increase the overall value, a loan can be an incredibly lucrative way to not only get more interest, but to recuperate those grant years that potentially they might have missed. The loan I want to mention is refundable at all times, but must be paid back or terminated prior to the beneficiary going to university or actually pulling out their first EAP payment. As we do offer competitive interest rates, I highly recommend looking into it, but in this interest rate high environment, it might not be something that you or your clients will consider until rates start to decline. One of the advantages about an RESP loan is there is no credit check, meaning that unlike some of our other loan products, we will not be digging into your clients' backgrounds as rigorously. Here's a little illustration of how RESPs can grow both with and without an RESP loan. Of course, initially, a subscriber will contribute to the RESP plan. The government will match with grant incentives. Interest, of course, is accumulated based on the contributions and the grants. And ultimately, the beneficiary is entitled to both the interest and the grants accumulated within the RESP plan before tapping into the contributions made for PSE withdrawals. An RESP loan, however, will have a little bit of an additional source of funding. In this illustration, we have IA funding the policy through a loan, matching the client's contributions and increasing the overall value of the plan. As a result, we receive more government grants and more interest is accumulated as well. So when the beneficiary ultimately goes to university, they go to university with almost double what they would have without the RESP loan in this illustration. What this essentially means is that the interest accumulated as a result of the loan and the grants that were allocated as a result of the loan have helped the beneficiary achieve a little bit more savings and potentially offset some of those heavy university costs. Lastly, I'm going to talk about what products we have at IA for the RESP plan. We have recently removed our diploma program, leaving My Education Plus as the only RESP plan that we have left. I do want to mention that the My Education Plus program is incredibly flexible and geared toward the client's success. It is available in both the individual and family plan, and there is no mandatory annual investment amount. This also has a complete 74 fund offering that includes our high interest savings account. All of these funds are 75-75 guaranteed, meaning that they have a 75% maturity guarantee and a 75% death benefit guarantee should anything happen to the subscriber. If clients have pre-existing accounts with IA in excess of $300,000, they will also be eligible to receive prestige preferential pricing for these clients. I also want to mention that the interest generated is accessible by the subscriber in the My Education Plus plan, and there are multiple options available if the child does not pursue post-secondary education. In summary, I do want to just recap that we do have a complete fund offering for both our individual and family plans. The contributions for My Education Plus are both flexible, as are the withdrawals, and the guarantees, of course, make this a fantastic product for you and your clients. The only products we don't offer in the RESP My Education Plus plan are GICs. In part 2 of our presentation today, we're going to focus briefly on generational wealth transfers for minor beneficiaries. Generational wealth transfers can stem from a variety of sources, whether it's a life insurance policy or inheritance. To start, we're going to just recap and break down very quickly the parties to a segregated fund contract. There must be an applicant, a successor applicant if someone is to take over on the death of of the initial applicant, an annuitant, so who the contract is actually based on, potentially a successor annuitant in a typical seg fund contract, and of course, the beneficiary or the party who would receive the death benefit upon the annuitant's passing. In a registered plan, the successor annuitant can only be a spouse or common law partner. However, in a non-registered plan, that does vary. I do want to mention this really briefly for people who might be structuring non-registered plans. This is unlike the formal trusts and the informal trusts that we're about to discuss really quickly in this part of the presentation. Formal trusts are something that we can hold in our IA contracts. However, they do require a lot of documentation and potentially notarization before we actually are able to open the account. As a result of this, the owner of the account, the applicant in this case, would be the trust itself. The annuitant would be one of the minor beneficiaries of the trust that has since been established. The administrator must be a trustee, a person past the age of majority who is actually monitoring the account on behalf of the minor beneficiary, and the beneficiary must be the trust itself. These are only available in non-registered contracts, and if you do have any questions about our ability to hold formal trusts, or if you have any clients looking into formal trusts, I do advise you to contact your IA sales director, as there are more documents required for opening them outside of the trust agreement or will. In some cases, we may request a POA or an estate breakdown in order to actually open the contract itself. Informal trusts, on the other hand, function a little bit differently. In this type of account, there's an individual that acts as a trustee for the minor beneficiary, but the minor beneficiary themselves is actually the annuitant. The beneficiary on the contract must be the estate of the minor whom it's in trust for. And the person administrating the contract has to be the trustee who takes on the responsibility of the contract until the minor reaches the age of majority, can actually take it over for themselves. I do want to mention that both formal and informal trusts are not bound by creditor protection. And if there is a bankruptcy proceeding, these could be targeted as a result of an investigation. Informal trusts don't require any written agreements or wills or trust statements, unlike their formal counterpart, and they can be established by advisors such as yourselves on the call today. Typically, when we receive an informal trust request, it is for an estate breakdown and for a minor beneficiary, perhaps, that is not near the age of majority and would like to, and the parent or the guardian would like to monitor them and help them grow their wealth and savings until they reach that age, at which point they can take it over themselves. This can be an incredible savings tool for minor beneficiaries to allow them to grow the wealth that they've inherited at a young age, eventually taking it over and using it for things that potentially the person that has left them that money intended them to do so. There's also a program at IA Financial that allows clients to divest their inheritance in a very unique way. In fact, in their way. Hence the name of our program, Inheritance Your Way. There are a lot of situations that clients have where they might not want to give their beneficiaries an entire lump sum of funds, but rather would like it to be doled out over a period of time. And this could be for a bunch of different reasons. Perhaps their beneficiary is a little bit spend hardy and might not be the best at managing a large lump sum of inheritance at once. Perhaps they require special care. Perhaps they require a stream of income. Inheritance Your Way actually has all of these solutions built into it and more, and can be entirely customized to your client's needs. As a result, a one-time lump sum payment could still be made along with a fixed guaranteed periodic payment over a desired amount of time. We can also structure this so it's a periodic payment over the life of the heir, and if desired, we can set this to a minimum guaranteed period to ensure that your client's heirs receive a stream of income in the event of the worst. In the final portion of our presentation today, we're going to be briefly discussing child life insurance and critical illness policies. Now, this isn't something that's typically discussed, and it is something that I wanted to take some time today to talk about, as purchasing life insurance for a child is not something that a lot of clients consider. In fact, most of your clients probably aren't considering purchasing life insurance for a young and healthy child. Over the course of this section of our presentation, I'm going to discuss why there is a lot of benefits in selecting a child life policy. Essentially, and in this little descriptor here on the Q&A, by purchasing life insurance for a child, we can give them insurability tomorrow and hypothetically protect their future in the event something happens. For starters, I want to say that if you take advantage of purchasing life insurance for a young and healthy child, they benefit from a reduced premium overall. As I mentioned on the previous slide, this guarantees their insurability for their older, sometimes regardless of the future state of their health. This is a gift for life at the end of the day. A lot of beneficiaries, even people between the ages of 15 to 30, might not consider life insurance as they themselves are young and healthy. However, by purchasing life insurance at a younger age for these children, you're actually reducing their premiums later in life. And by the time they've decided to start their own family, they'll be thanking you for keeping their premiums down. In the typical financial analysis, while life insurance is considered to be paramount for children in this sense, critical illness insurance is also something that is incredibly key to ensure the success of the future generation. I'm going to talk about some stark statistics on the next slide here and what critical illness affects children the most. Unfortunately, cancer is the second highest cause of death among children in Canada ages 1 to 14. This is at a rate of 1 in 400 children being stricken with cancer prior to the age of 15. Having said these stark statistics, there is a silver lining to it, as 75% of children that are affected with childhood cancer will recover. During this time, it can be quite taxing on the family, and of course, it can be incredibly stressful. By purchasing a child life policy, of course, you are not only ensuring that your child has protection, but that you can also be there to support them during their recovery and eventual recuperation. In the event of the worst, of course, this can help with planning out any of the estate costs of the child's demise. Children at the end of the day should not have to compromise when it comes to their finances, especially if those finances have been set up by pre-existing factors. As a result, whole life insurance coverage combined with an early face value payment of 50% in the amount of critical illness can really help in the event of an emergency. This is also coupled with the fact that there is an opportunity to convert this to a term critical illness coverage into permanent coverage by the age of 30. As a result of paying these premiums up front, when the child actually reaches adulthood, they benefit from a coverage for life with no premium payments, regardless of their current state of health. It's an amazing incentive and something that I think we should discuss a little bit more, especially when talking about children and their insurability. Ultimately, the reason why we purchase critical illness and life insurance for children is for the parents. The parents are going through an incredibly trying time should their child be sick. No child should suffer through these things, and if we could, we would eliminate childhood illness in Canada, but unfortunately we can't. But what we can do is we can give clients the financial resources to take leaves, support their children, and be at their side during treatments and recovery. Additionally, I want to also point out that these coverages don't just extend to the financial resources, obviously, and the means to take an unpaid leave. They can also be used to pay for additional expenses, such as experimental drug treatment plans that would not be covered by a public plan or even by some insurance companies. Medical care can also be something that is sought out by parents in this situation. There might be a specialist in another province, for example. Travel to those provinces or locations to receive medical care can be expensive, and having a child life policy can ultimately help pay for those lofty expenses. Ultimately, what this policy can do is help the client protect their savings, so hopefully when their child does recover, they can do something fun with them, like do that trip to Disney World that they've been hoping to do during their child's entire illness. It can be a real silver lining that they have their savings protected while tapping into this insurance policy to help them get through what is assumably one of the most difficult periods in their life. Before we wrap up our presentation today, I know this was a lot of information coming at once, so I want to recap really quickly in each individual part that we've discussed today. For RESPs, what I want you to walk away with is that all your clients take advantage primarily of the CESG and CLB programs by maximizing contributions at $2,500 per year and contributing periodically. Keeping in mind that these contributions can also be recuperated from previous years for a maximum of $5,000 per year to get the current year and a previous year missed. We can only go back 1 year at a time, so I highly recommend not exceeding a $5,000 annual contribution if this is the case. This also will help ensure that your client's children have an amazing financial standing going into university, as university costs have only increased in the last 5 years in Canada. If the child chooses not to go to university, of course, there are multiple options that we can use the RESP contributions and proceeds towards. First and foremost would be the RESP to RRSP transfer to allow the parent to actually pay for their retirement or potentially tap into it as part of the lifelong learning plan if they want to go back to school themselves. From our generational wealth transfer section, I want to reiterate that there are a lot of options available at the financial institutions in Canada that can ensure your client's children are entitled to their money that might come from a myriad of sources. Trusts are, of course, a useful tool for minors as they offer long-term growth and savings, but they are not bound to creditor protection. As a result, there are other programs, such as the Inheritance Your Way program that we discussed, that can be a great way of sending inheritance through to other beneficiaries. In our child life and critical illness section, I want to reiterate the biggest point of this plan and these policies is to give clients the flexibility to take an unpaid leave, to be at their child's side during the treatments that they might be enduring, and obviously help them with the recovery stages. As this is advantageous for children when they are young and healthy, they do benefit from a certain coverage for life with no premium payments regardless of their future state of health, something that can really help families and ultimately help those beneficiaries down the road. I'm going to wrap up our presentation here today. As you can see on the screen, my email address along with my sales director is posted here. And I do want to thank IDC for being such gracious hosts and for allowing us to present to them today. If you do have any questions and you've forgotten to take down your wholesaler's information from the beginning of our presentation, please feel free to send either Angelina or myself an email, and we'd be more than happy to get you in touch with the people that are in your region. We're here to support you at IDC and help you grow your business in any way we can. Thank you very much.
So thanks. Fantastic information there. Lots and lots of stuff. Hopefully everybody's taken a bunch of notes. I made some stuff as well, just some quick things outside of your conclusions. I think you mentioned this is free money, the grant in the RESP program. We're all being squeezed on living expenses right now, obviously, what's going on in the world. And it's definitely a help to achieve goals for the future, for newborns and so on. Costs are not going to be reduced for education. It's going to be the opposite. Costs are going to increase. So every dollar that can go towards that education cost is going to be very, very helpful. The RSP loan, I think that's something that they won't really think about. That's not something that pops to mind when we talk about this program. And again, there's something that's going to get more money into action and help the costs in the future. So fantastic. Control from the grave, inheritance your way. That is really, really important. You were very polite about that, but when there's multiple kids in a family, there's usually one of the three is a problem, and an inheritance is just too much for people to handle. So a fantastic thing to use. Gift for life, that's a lovely thing to say. When it comes to the insurance side, it truly is something for the future. Guaranteed coverage, reductions in premiums for life. That's it might not seem like a big deal right now, but it will be, as you said. People will be thankful for that in the future. So great stuff to catch up. There's a lot, and I do encourage everybody to reach out to yourself, Angelina, or any, obviously, the other respective wholesalers around the country. There was a couple of questions that came through, so we've got a couple of minutes if that's okay with you.
Perfect.
Here's an interesting one. I don't know if I'm not too sure the answer. I think I know what it is, but I'll leave it to you. What happens to the RESP when both parents die on a joint subscription?
That is a fantastic question. So there is the ability at IA plans to actually name what we call a replacing subscriber. In this case, that person could be either a guardian or a blood relative of the beneficiary. Potentially, I like to lean towards guardian, someone who's actually named in an agreement or in the will as the person who would be responsible for the child's well-being. If a parent trusts, obviously, a guardian with their child's well-being in the event of their death, they'll definitely be able to trust them with with monitoring their RESP plan and monetizing it into action when the beneficiary does become of age to go to university. The best part about our RESP plans, of course, when both parents do die, is the death benefits. So if the RESP plan was perhaps at a bit of a lower value, the death benefit, of course, does kick in to ensure that the child is not subjected to those losses. The lifetime maximum amount for CESGs, I do want to point out also, is $7,200.
Yeah.
I did see that question just
That
below.
could probably, yeah. So that was from Vicky, and the last question was from Geronimo. And here's the first one that came through here is: can a contributor take out all the contributions and an interest if the beneficiary does not go to further education?
So we did touch upon this in the presentation, but I want to reiterate that yes, the contributions do belong to the subscribers at the end of the day. The interest, however, is taxable to the subscriber if withdrawn. So what I always like to point out is for an EAP, an educational assistance payment, use the interest and the grants first. Your child might not be sold on university. Maybe they'll go for 1 year of college or university, and then maybe they'll take a year off or do a sabbatical before going back. If we at least take advantage of the grants and the interest first and the contributions are left over, there's a lot of different options that the parents now have with those contributions. They can, for example, roll it over to an RRSP using the T1171 or a spousal RSP if they or their spouse do not have retirement savings yet, making the RESP just a little bit more flexible for parents in terms of what they can do with their overall wealth accumulated there.
Perfect. Okay, I think a couple of questions snuck into the chat as well. Let's just see
Fantastic.
here. Wow, I'm not too sure about this. At what point in our interest rate would be best to do RESP loan?
So the interest rate is based on prime. The
Yep.
prime rate currently is quite high. I would recommend looking into this over the course of the next 6 to 8 months as we are starting to enter a bit more of a stabilized interest rate environment. We might even start to see interest rates begin to fall as we get into autumn and winter seasons. So currently, while interest rates are high, it might not be the most advantageous things for clients to take advantage of, especially if clients come from a household where their income might be lower than $50,000 per year. However, in the coming months, we should have a bit of a clearer picture on the interest rate environment in Canada, and it would be a good time to reassess whether or not a loan is right for your client, especially if they have previous years that they can actually make up for in terms of grants. That's what we're taking advantage of with RESPs at the end of the day. We really want to stress that first and foremost, as Graham was candid in saying, this is free money from the government at the end of the day, and anything that we can do to guarantee your clients are entitled to that free money is amazing. The RESP loan is just another way of adding to the overall contributions into an RESP plan, and your clients might already be making PADs on a monthly basis or an annual basis. With the loan, we can just overall increase the AUM in the plan, increase the interest, and increase the grants that the child is eligible for.
Perfect. Well, there's a whole bunch of comments here from your fan club, so we'll skip those. I know it was well enjoyed. And the last one here, I think, is how will the beneficiary remain a Canadian resident if he or she is going? I think is going abroad for more than 1 year of study.
So the beneficiary would actually, and this is a fantastic question, one that's not actually addressed too much, both in presentations or in general. Often when students go abroad, they don't actually leave their residency altogether in Canada. They actually go on what's called a student visa, either to the UK or to the US, being the two most common countries that Canadians go for post-secondary education within. As a result of that, they're not technically full-time residents of either countries, and they remain a full-time resident of Canada. As long as they maintain their residency here while tapping into their RESP plan, potentially immigrating to those countries in the future, that's fine. We're more than happy to accommodate students in other countries as long as they remain a resident here. A visa, in essence, wouldn't affect that, especially for educational purposes. And I speak from experience here because a good friend of mine did go to school in the US, and that's exactly what he did. And he's still on a student visa there, currently doing his graduate degree.
Cool. So here's the last one here. Since when has the grant changed to 10% for higher income earners?
So I think that might be a bit of a miscommunication. There is a 10% for the people who have a household income between 50 to 100,000 and 20% an additional grant for people who are under 50,000. In Quebec, however, this is a little bit different. There is 10% for people under a $49,000 mark, and there is only 5% available for people over that net income mark. So that is a little bit of the difference just between the CESG and the QESI. If you do have any questions about both of those programs, I highly recommend getting in touch with your internal wholesaler. They'll be able to reiterate some of the content of my presentation. And I also want to mention that I do believe this presentation will be circulated by IDC in the form of a PDF. Yep. So if you ever have any questions or would like to reference some of the material presented here today, you're more than welcome to it.
Perfect. Yeah, we'll be putting that on Winbig for sure for future reference. And again, from our point of view, thanks very much for taking the time. It's brilliant to have you on board. I will point out myself and my colleague Alex out west. If anybody needs contact details for the IA team, obviously we're here to help to facilitate that and get some RESP business in the door. So, Fraser, thank you very much. Thank you everybody for attending, and we'll call an end to that with just basically 1 minute to go. So, thanks again, everyone.
Fantastic. Thank you guys so much for your time and for having us here today.
Thank you.